Hey guys, welcome back to this channel. Hope you guys have a wonderful day. It has been raining for nearly a week. Apparently it has one of the biggest rainfall that we have in 50 years. That's what the news media is saying. So, hope you guys have a wonderful day. It's gonna be a fun day today for me. If you guys are new to this channel, I talk a lot of things when it comes to personal finance. So in this video, I talk about that. If you're new, if you like this type of content, by all means subscribe, comment, and share. It would be muchly appreciated. So in today's video, however, because of the rain and storm that is happening right now in Sydney, the more important thing is this is why you have insurance, have some sort of cover in case if anything happened. But that's not the topic that I'm trying to get today. So a few days ago, I had a conversation with a client of mine when it comes to property. So this particular person had 3 different investment property, ranging, let's say, in the lowest scale, roughly about $100,000 left on the mortgage. The other scale, it's actually about $250,000, and another one roughly about $300,000. So 3 different property, 3 different price point. Now, I comes to realization that, we talk about, hey, leveraging debt, but sometimes if it doesn't make sense, it doesn't make any sense. So I try to minimize debt. That's what my wife and I decided to do. How do we eliminate debt as much as possible? And because if you eliminate debt, if you don't have any payments, including a mortgage, life is much more simpler. So we come to a plan. We devise a plan and say, it's called a snowball effect. So you pay the lowest amount to the highest amount. In this instance, the $100,000 was the option number 1. I looked at the paperwork, I looked at how the financial structure works on this particular transaction. Now, it turned out to be that they can pay off $5,000 each year without incurring any penalties. Now, some product out there, if you pay a certain figure or a certain amount, you will you actually end up getting penalized. I don't understand why. I thought the concept of it is, hey, you pay off your debt, especially your mortgage, as quickly as possible. But in a banking world, from what I realized, that each product anyway, have their own different structure, or each mortgage. That's why I always ask, how much can I pay off upfront before I incur any penalties? Some of them say you can pay as quickly as possible if you wish, or you can pay this amount before I require a fee. Because after all, in the banking world, they're trying to make money. So if you pay them off quickly, that means they're losing their profit, they're losing their interest. So hence why they don't want to do that. I think this is the reason why a mortgage goes, especially in Australia anyway, goes for 30 years for a property mortgage. Because the amount of, if you do the maths on like a 30-year mortgage, you end up paying at least double minimum. And if you're making just on a regular repayment, monthly repayment without doing anything. Some of them do actually provide an interest-only product that goes for a certain number of years. On an average, 2 years to 5 years. That's an average that I've seen so far, where you can only pay, pay interest only. But I do not recommend that. 5 years in a blink of an eye. Right now my kids is already 5 in a blink of an eye. And when that happens, your repayment will go a lot higher, because now you have to pay the principal and interest repayment based on 25 years mortgage. So I would rather start paying the principal as well as the interest as quickly as possible. And for some, it's I guess a major factor, because let's say you were comfortable paying interest only of X amount of dollars, let's say $500. But at the same time, within that 5 years, your income hasn't increased. Your income is still stagnated at that, whatever it is. Hit the 5th year, before you know it creeps up on you. On the 5th year, now you have to pay principal and interest repayment, and that repayment now becomes $750. So for some, it might be a very like a choking area, because where are you going to come up with an extra $250 repayment if you're not used to it? And that would be a lot of strangle, I guess, on your budget or on your cash flow, if you weren't prepared for it, which I nearly got caught out on that actually. I personally, I nearly did, because we were paying interest only, and that wasn't cool. Luckily, we changed our strategy to change that principal and interest as quickly as possible, because the concept of it is pay off your debt as quickly as you can. Because if you keep on paying debt, or if you're paying just interest only, interest, you still owe the underlying amount that you owe to them. So yeah, and I do not. Well, that's from my own personal experience anyway. I don't want to do interest only, because you're paying to the bank their profit only. You're not getting any share of your part of the house. So yeah, not worth it. So this debt snowball effect that I do, I guess if you guys knew, is paying off your smallest debt to the largest debt. So in this instance, the $100,000 debt is the smallest mortgage that they have. So pay that off as quickly as possible. And then the second one, and then the third one. And if you don't have any more payments to the bank, life is much more simpler. And you don't have to worry in case of a tenant, let's say, moving out. You don't have to drop your price. Let's say if they're having a hardship in terms of losing their job for whatever reason, then you don't have to worry in that aspect of it, because you can observe, absorb the rent decrease, or if not, whatever reason it is. Whereas beforehand, when you have repayment to the bank, you've got no choice. You have to make a payment. You can defer that repayment, but at the same time, the interest is not going to get deferred, so your repayment is going to go higher. You extend, either the repayment is going to go higher, or if not, the time is going to get longer. And you don't want to do that. Well, I don't want to do that. I want to pay it off as quickly as possible, because like if you don't have any payments to anyone else, life is much more simpler. I told this client about that concept of just paying off the debt as quickly as possible. At a very bare minimum, is paid the minimum, the $5,000 that they can pull additional without having any penalties. Some bank, or some product anyway, from a mortgage product, some of them can pay up to $50,000. I was quite surprised when I see that. I'm like, oh, you can pay an extra $50,000 without incurring any penalty? I would do that. So, and how do you do that? Well, it's up to you how you come up with the extra fund. Having side hustle and whatnot. Do whatever it takes in order for you to achieve your financial goal. But yeah, that's how I would go about. Now, this doesn't just apply on a mortgage type of product. So if you have, for example, a credit card, multiple credit card, you do the same thing, as in you pay off the smallest credit card. If you just go through every single balance that you have, and then you go through which one is the smallest balance, and you pay that off first. But once you pay that off, you close it, and you pay another one, you close it, you keep on paying. So let's say if your minimum repayment on a credit card of I don't know, $500 a week on, let's say, 3 different credit cards. One of them it's $100 per week, the other one's $125, and the other one's, let's say, $200, and then the rest of them. So I pay off that $100 credit card one, pay off the balance as quickly as possible, and pay off the bare minimum on the rest, and then the second one, and then the third one. This way it's the debt snowball, in a sense of, if you get used to doing that on your personal consumable debt, the next things, I just apply the same principle into your mortgage, especially if you have multiple mortgages or multiple investment property. Do the same thing. Whichever one's got the smallest mortgage, focus on that. If you're able to make additional repayment, then make the additional repayment, as long as there's no additional fees involved with it. So contact the bank on a regular basis. I do it once a year at the very least, and just checking out and go, where are we at, how much we owe, are we on a good terms, or can we pay off a little bit more faster. Some of them change their product, and some of them able to transfer you to a new product with the same bank with a lower interest rate, and with the that you can actually pay off a little bit more quicker, and all that jazz. So yeah, that's it for now, guys. So if you like this type of stuff, this is based on my own experience, my own personal finance, and yeah, if you like this stuff, don't forget to subscribe, comment, and I will see you guys on the next video.